Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, it's episode number 91, and we cover an interesting trend in the investment markets, and that's all these mutual fund managers that are converting their funds to ETFs, or exchange-traded funds. It's a little bit of jargon there, which I apologize for using. What it means is that the structure of what you have in your investment accounts might be changing a little bit because of how the investment markets are evolving and maturing. It's an interesting thing from my perspective, and it's something I felt compelled to cover on the podcast because it does have implications for investors like you and me. I hope you enjoy it. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. So this week on the podcast, I'd like to talk about this emerging trend that we're seeing in the industry, and that's of mutual funds that are converting to ETFs. And for a lot of you listening, those words may not mean anything to you. And that's okay, because today on the podcast, I wanted to cover what that means and why some of these investment managers are deciding to convert their fund and investment options from a mutual fund structure into an ETF, because it has implications for us as investors. It's a really interesting trend from my perspective as the industry grows, evolves, matures, all of the above. And it has it has implications for us as investors, and therefore is important, I think, to cover. So let's start this week by just covering an overview of the difference between mutual funds and ETFs in the first place. I believe that I've rambled on about this a little bit in the past, but a refresher might be helpful. So mutual funds are an investment vehicle that have been around for a long time. Mutual funds are typically, I think they're always structured actually as registered investment companies pursuant to the Investment Managers Act, I think is what it's called, of 1940. And in the industry, we call it the 40 Act from 1940. And so basically what it means is it enables this pooling of investment resources in the way that enables a fund manager to handle collaboratively a bunch of money for a bunch of different people and form what's called a mutual fund. And so the reason that this is beneficial to us is if you're someone who has $10,000 to invest and you want broad diversification, you want to buy every single stock in the U.S. Markets, that would total up like more than 3,000 different individual stocks. And some of them are trading for hundreds of dollars per share. Some of them trade for a couple of dollars per share. But if you have $10,000 and you want to buy everything in the U.S. market because you understand that you want to be diversified, $10,000 is not going to get you there. It's not enough money to buy one share of all of those 3,000 different stocks. So what you can do instead is give the $10,000 that you have to a mutual fund manager. And what the mutual fund manager and that fund company does is pools together investments from a bunch of different investors. That money goes into a pot collectively. It's technically held in custody in a trust somewhere. But the idea is that pooled money then is a sufficient enough size to go out and buy at least one share of all the 3,000 securities in the U.S. And if you have 100 people who each put in $10,000, then you can evaluate what the total value of the portfolio is, and you have, 1% ownership of that collective group of funds. That's how a mutual fund's structured. And so when you buy shares of a mutual fund, you give money to the manager of that fund in exchange for a commensurate number of shares in the portfolio. So if you want to, if we have 100 different investors who are all putting in $10,000, and then on day 2 you want to put in another $10,000, well, the mutual fund manager is going to take your $10,000 and issue you a corresponding number of shares. And the number of shares you get back is based on the net asset value of that portfolio at the end of the day. So there's no intraday trading here of mutual funds. It's all based on net asset value at the end of the day. So you know what's in the portfolio as of yesterday. The market opens in the morning. The value of those stocks go up and down as they tend to do in the capital markets. And then at the end of the day, every single day, the mutual fund manager has the obligation of valuing each of the holdings in the portfolio and calculating what the net asset value of one share is. So if the result is that on day 1, the portfolio is worth $25 per share, and then on day 2 in the morning, you give that mutual fund manager another $10,000, but the market is down, and at the end of the day, the net asset value is only $20 per share, well, you take 10,000, you divide that by $20, and you get, 500 shares, I guess, of the resulting or of the mutual fund at that new price. So that's how it works. It's valued once a day. The mutual fund manager is doing the exchanging. These days, there are a bunch of different ways to access mutual funds. For example, if you buy Vanguard's total market mutual fund, you can give Vanguard money and they'll then give you a corresponding number of shares. You can interact directly with their mutual fund manager. What you can also do at Vanguard is open a brokerage account, and you can buy individual stocks in that brokerage account. You could buy shares of the mutual fund in that brokerage account rather than transacting directly with Vanguard's mutual fund company. And I know that's a little bit confusing. It's kind of an opaque concept, but it's very helpful because when we manage money for clients here at the financial planning firm, we do it through Charles Schwab. We help people open accounts there. They put money in. We can buy Charles Schwab mutual funds, but we can also buy Vanguard or any other mutual funds because that brokerage account is a vehicle where you can put anything you want in it that Schwab will hold on its balance sheet. You don't necessarily have to transact directly with the mutual fund. So that mutual fund structure that I'm describing is a really popular, really beneficial thing for investors. It's been around for a long time. It's led a lot of people to really good investment outcomes. There are always bad cases here and there too. There are a lot of mutual funds that have gone belly up over the years, but it's probably the most famous diversified investment vehicle to date. Now, over the years, we've recognized that there are some limitations with the mutual fund structure. And by and large, today, investment companies who still use mutual funds as the structure for their investment vehicles have navigated these limitations with a lot of success. But they still are somewhat limitations. And what I mean by that is, number one, there are tax treatments that are not always that favorable. So back to our example, let's say that you and 99 other people each put in $10,000 into this pool of money at a mutual fund manager. You take the manager buys a bunch of stocks with that $1 million, and then let's say that the market falls and half or 50 of the investors who each put in $10,000 decide that they want out and they want to sell. Well, the mutual fund manager is obligated to redeem their shares. That's part of the gig when you're managing an open-end mutual fund like this. And so if they've taken the $1 million that you and the 99 other people have put into the mutual fund. They've bought a bunch of stocks with it. There's no cash in the mutual fund because the purpose of the investment was to buy stocks. And now 50 people want out. Guess what? They're going to have to sell a bunch of shares in order to raise the cash and redeem the shares and give the 50 people who want out their money back. They are obligated to do that. And in the scenario that I just gave, a market crash might be an event that prompts 50 people out of 100 to want to exit and sell their shares in the mutual fund. But there are tax ramifications of that. And the deal is, if the market is up, let's say the $1 million that you and 99 others put into this fund goes up to 1.2 million and appreciates by 20%, and then something happens to where people want out of the mutual fund and the manager is compelled to sell stocks, well, guess what? The mutual fund has a taxable gain from the sales of those securities that they're compelled to sell in order to raise cash to meet redemption requests. And at the end of the year, the mutual fund is also compelled to distribute those capital gains, taxable capital gains, to each of the remaining investors. So what will happen sometimes in these open-end mutual funds is you get a nice fat love letter from your mutual fund company that will often come with a cash distribution, but it'll also be a taxable gain that you might not really want. And in the scenario where the market is crashing, and which is prompting investors to want to get out, that's not really that big of a deal a lot of the time, because if the values are down, you're not going to have as large a gain as if the values are up. But then again, we've been in this long-term bull market for quite a while here, with a short interruption for COVID last year over 3 or 4 weeks. But there are a lot of unrealized gains embedded in a lot of the mutual funds in the US today. And if those mutual funds were forced to sell to meet redemption requests, shareholders would likely get a taxable capital gain that they might not otherwise want. So it's a limitation of the structure. If you're an investment manager and you have some strategy that you want to pursue and it's done really well, and you have investors who want to invest with you because you're a great manager in that strategy, a mutual fund is still a really attractive place to be. This tax issue is a limitation, but you also have some, you have to calculate the net asset value every single day and share that information. But a lot of investment managers don't necessarily want to report on their holdings in the portfolio every single day. There's a transparency issue. They want to do stuff in a black box so that others aren't replicating exactly what they're doing. It's less hassle for them, frankly, when they don't have to report back to the authorities every single day. And in a mutual fund, you have some latitude there surrounding when and how frequently you're reporting on the activities and the trading of the fund. You do have to, again, calculate net asset value, but that's a little bit different than tracking exactly every single transaction within that portfolio. So that's what's been around for a long time. Here, a couple decades ago, when we as investors and the investing world became more interested in index investing, a newer type of investment vehicle was created called an exchange-traded fund. So with the mutual fund, you're buying and selling shares directly with the mutual fund company. You're not exchanging those with other investors in a market-based way. You're buying and selling shares with the mutual fund manager. They're then investing that cash through those market mechanisms. Closed-end mutual funds are a different animal. I'm going to skip over that for today. Exchange-traded funds are different. So in an exchange-traded fund, you might have an exact same. So let's use the exact same example. There's people out there who want to invest in the total US stock market, which is over 3,000 different stocks. If you want to buy the Vanguard Total Market Fund, you could buy the mutual fund, but there's also an exchange traded fund, which is the exact same portfolio, but in a different wrapper. And when you buy that fund, you're going to your broker, telling them that you want to buy X number of shares, and you're giving them pricing parameters over how much you're willing to pay for them. They go to the market and then they transact on your behalf. So you're buying these funds at market prices. They're not managed in the same way. So if you're Vanguard and you have this total market exchange traded fund, what you're doing is licensing out the buying and selling, or rather the creating and destroying of shares to what are called authorized participants out there in the markets. And really what that means is that they are institutional players, most often affiliated with trading desks at big Wall Street banks. And when you launch one of these ETFs, you have a number of these players, usually at least half a dozen, I would think, who have the ability and responsibility to create and destroy shares of the ETF. And the reason is that if you have the 3,000 shares in this total market index that the portfolio represents, the shares of the fund itself trade over the exchange. So let's say that the one share of that ETF is worth $100 on the exchange. In other words, you can go to the exchange and buy a share of this fund, of this portfolio, for $100. But the corresponding value, if you took the number of the value of each of the portfolio holdings and then divided it by the ownership right that you have to by purchasing one share, sometimes the value of the holdings might only be worth $95. So why would you want to pay $100 for a portfolio that's only worth $95? That's where these authorized participants come into play, because you can buy shares of the fund itself over the market that are, and the pricing of that's based on supply and demand, like any other underlying stock. The value of the underlying holdings also trade on the exchange, each individually. So what happens is these authorized participants have the authority to create and destroy shares. And in this example, what the authorized participants would do is if the underlying portfolio is only worth $95, they have the authority to buy every single holding in that portfolio. So if they use their own cash, they buy all the holdings in the portfolio, they package them together, place them in a trust, just like you do with a mutual fund, and then they sell or issue or create shares of the ETF and sell those on the open market. So from their perspective, it's a market-based arbitrage mechanism where I can buy all the stuff for $95 and sell it for $100. So there's financial incentive for authorized participants to be engaged. And the fact that there are a number of these throughout the market, it's profitable for them to do that. But because there are several operators that are doing this, it prevents the price of the ETF to deviate that much from the underlying portfolio. So this is it's a really interesting twist. And remember what we have with the mutual fund, where you want to buy the 3,000 shares in the U.S. index. You give your money to a mutual fund manager. They tell you what it's worth every single day. That's part of their obligation. It's calculating that net asset value based on the market prices of each of the underlying companies. When you buy the ETF trades for one number, all the underlying companies trade for another, and market forces prevent those two items from deviating by too much. Now, let's say that the reverse is true, and the underlying companies are worth 100, but the ETF is only trading for 95. So in this case, the supply of the ETF is exceeding the demand. So what does the authorized participant do? They buy up a bunch of that supply on the open market of the ETF. They have the right or authority to repackage that. So they buy the shares of the ETF for 95. They have access as an authorized participant to destroy the shares, redeem them for each of the underlying holdings, and sell those holdings on the open market. And so in this scenario, you can buy for 95 and sell for 100. They're going to do that 10 times out of 10. In practice, the dispersion between net asset value and market price of the fund is not that great. And we're talking about an index fund and just slivers of differences between the net asset value and the market price of the fund. Because banks see this and trading desks see this as an opportunity. And when it gets too large, they pounce and jump on it, which as an investor in ETFs, it's helpful. The risk there, of course, is that under times of extreme financial duress, banks have a lot of capital and balance sheet limitations. And having been at a large institution during the mortgage crisis, I can tell you that executives, when the you-know-what is hitting the fan, have to make decisions about what businesses to allocate their capital to, what's going to be good for shareholders, what's going to be good for clients, and what businesses to get out of. And if it's not a terribly profitable business, I can see situations where these authorized participants might remove themselves from the game, and with fewer authorized participants, prices can deviate farther from their net asset values. So it's an interesting format. It's an interesting mechanism for investing in a pooled way. And the primary, and so you might be thinking, well, why on earth would I want to do that? If the price can deviate from the underlying holdings, why wouldn't I just go with a mutual fund? And the primary reason there is it's a little bit more tax efficient to do that. So in a mutual fund, if you have a bunch of redemptions, the portfolio manager has to sell holdings, and the tax ramifications will be borne by the mutual fund owners, the holders of the fund, whether they like it or not. But with an ETF, remember how these shares are created and destroyed. The authorized participants buy up the underlying holdings or sell the underlying holdings and repackage them by grouping them together, creating shares of the ETF, or taking shares of the ETF, breaking them apart, and selling the underlying holdings. That exchange, that creation and destruction of new ETF shares being created or existing ETF shares being destroyed for the underlying holdings, that's considered a like-kind exchange in tax speak. And because of that, you don't have that issue as an owner of the ETF of having a whole bunch of capital gains distributed to you because other shareholders wanted to sell. The ETF is compelled to distribute some capital gains to you in some circumstances, but you totally remove that issue of redemptions affecting other shareholders from the equation. So by and large, they can be a much more tax-efficient vehicle in the right circumstances. Now, over the years, mutual funds have taken all shapes and sizes and forms. And there are mutual funds that pursue all sorts of crazy strategies. There are index mutual funds. They cover all sorts of different asset classes. And that kind of structure is helpful if you're doing some non-traditional strategy or something that's a little bit fancy, where you're maybe shorting stocks in a long short strategy, or commodities based, or something where you're having a lot of trading discretion. A mutual fund is a very helpful structure. because you don't have to report on the holdings every single day. All you have to do is just calculate and distribute the net asset value. In an ETF, the rules are different. In an ETF, you have to communicate the composition of the portfolio every single day, whether you like it or not. And that's onerous for a lot of mutual funds and mutual fund strategies. So there's a little bit of background there. Might have been a lot more than you ever wished to know about these two investment vehicles. What's interesting is that as the world has moved toward lower cost index investing, which is good, ETFs have become far more popular. And some of the data that industry peeps like myself like to take a look at from time to time is how much money is flowing into or out of mutual funds in general, and how much is flowing into or out of ETFs. And the trend for the last decade plus has been net out of mutual funds, net into ETFs. And that's the right way to do it from my perspective. Because when you're investing in an index, there's not a great reason to go the mutual fund route as opposed to the ETF. There are, in certain circumstances, we have portfolios for our clients where we have index mutual funds, and it's functionally the same, particularly inside of retirement accounts. So there are a lot of circumstances where they make sense, but that flow is logical to me. Now, back to the trend of what we're seeing now. We're seeing some mutual funds actually convert the structure of their investment vehicle from a mutual fund, taking the same portfolio, and now we're going to call it an ETF. That is interesting to me. And what it tells me is that the mutual fund managers are sitting there scratching their heads, trying to plan and build strategy for their the business of their investment company. They see these flows and these trends, and they want to take advantage of them because ETFs are growing in popularity, whereas mutual funds are declining in popularity, other things equal. And whereas years ago, that requirement of publishing the portfolio holdings every single day, whether you like it or not, is unattractive, in 2019, the SEC started relaxing some of those standards. So the reason we're seeing this trend now is because the SEC approved its first quote-unquote active ETF back in 2019. And whereas you still need to report the holdings of the ETF, you don't necessarily have to do it every day. And it's basically a situation where the regulatory philosophy and thinking on this has evolved and changed, and the SEC is just a little bit more comfortable with it now than they once were. So we're getting reports where mutual fund managers are scratching their heads saying, you know what? If we don't have to report every single day, if we can get SEC approval to take our existing mutual fund and just move it into an ETF, maybe that makes sense. What they don't want to do is create an ETF that runs in parallel with their mutual fund. So they don't want to have two identical vehicles, one being a mutual fund, one being an ETF. And from the fund manager's perspective, one fear is that it's going to cannibalize the business a little bit, and neither will be as effective than if you had one. A secondary reason for that is if you're a mutual fund manager that has a long track record of performance, even if all you're doing is tracking an index, performance record is important. And the longer that you've been around, the more stability that tends to insinuate, the more that investors in general are comfortable going with your product. And so they don't want to start a track record from scratch, and they don't want to cannibalize the business of the mutual fund. So for those exact reasons, there are some mutual fund managers out there that are concluding, hey, we're comfortable with these newer, somewhat relaxed standards. Maybe we need to report on our holdings a little bit more frequently than we would have than we do under the mutual fund structure, but we're comfortable with these requirements, And if we can maintain our track record and convert what we have in the mutual fund to an ETF, that's going to be good for business. So that's what we're starting to see. Dimensional Fund Advisors has done this with a couple of their tax-focused funds, which I think makes sense. They, in particular, have done a pretty good job managing taxable distributions in their mutual funds, and they're so big now that any one or group of investors that redeems, it's a drop in the bucket compared to the rest of the fund holders. So you don't have that big tax problem with Dimensional in particular, but it allows them to maintain track record, and they have some tax-focused strategies where the ETF really does make some sense. Now, what I really wanted to focus on today is, what does this mean for us? You're probably listening to this, if you're still listening, thinking, all right, cool trend, but why do I care about it? Well, it's not unlikely that if you're investing in mutual funds now, you might run across this at some point. Maybe sometime soon, maybe you've already run into it, maybe a couple years from now. But this is the trend, and I would expect more mutual funds to convert to ETFs as the SEC's thinking evolves and as fund and investment companies become more comfortable with the implications of operating as an ETF. So there are a couple things that are important to understand and consider. One is that mutual funds will often come with a bunch of different share classes. American funds, for pretty much all their offerings, as I understand it, have multiple different share classes. A shares, B, C, and then different levels of institutional shares. With an A share, typically what you're doing is you're giving money to the manager, American funds, you're getting shares in return, but you're paying a front-end load or an expense for buying the shares on the way in. Usually, historically, that's been 4.75% of all your investments are being taken up front for the fee. And then you're paying an ongoing expense, which is really expensive. And that A-share mechanism is starting to go away. There are a lot more cost-effective ways of obtaining mutual funds. If you have A-shares, please take a look at them. Call me. We can look at them together. There are far less costly options out there. B and C shares are different variations on that theme. They have loads on the front end or the back end. So if you sell, there'll be a load there, particularly in a C share. But the idea is, if you're going to take a mutual fund and convert it to an ETF doesn't have any of those loads or expenses when you buy and expenses when you sell, because it's all done over the market. You might need to pay your broker a commission of a few bucks to transact on your behalf, but they cannot impose any kind of load type of expense for buying or selling an ETF. It's not free. You do have an expense ratio that you pay. So if you have a $10,000 position in an ETF, if it's the Vanguard total market index, you're paying I don't know what it is now, between 0.03 and 0.06 probably % per year from your investment paid to Vanguard for operating that investment vehicle on your behalf. But by and large, it's a less expensive way to operate if you're in one of those higher cost share classes. So the question for mutual funds is, I've got all these different types of share classes. What the heck do I do with them if I'm going to collapse the portfolio and move it into an ETF with one unified fee structure? And what I would expect to happen is, if I were running a mutual fund, I would probably think about collapsing all the share classes into one mutual fund share class first. And that can be scary for investors. I've had this mutual fund for a long time. I'm happy with it. It's done fine. I don't like change. Why is this changing on me? What's going on? Well, I don't fully understand the legalities of this, but I have to assume that it's pretty much impossible for a mutual fund company to, if you have different levels of fees for the different share classes, I can't imagine that a mutual fund manager would raise collapse all the share classes and raise the baseline fee to the highest level. I have to assume that they're going to reduce all the higher share class fee structures to the lowest level before converting, because the lowest level is a lot similar to what the cost of the ETF is going to look like after conversion. So if you experience that, you have one share class of a mutual fund and then it changes all of a sudden, that's probably to your benefit. Again, every mutual fund manager is going to handle this differently. I don't fully understand the legalities, but I would not be too freaked out if I were a holder of an A share. Now all of a sudden it looks a little bit different. If they've not communicated what's going on, they do have to. I don't know whether they can change the mutual fund share class without notifying you. I suspect not. But they will notify you if what you hold is going to be converted to an ETF. So that's something you ought to be aware of. It's not necessarily a bad thing, but I would probably want to know a little bit more about what's going on. Now, on top of that, remember the ways that you can purchase a mutual fund these days. Number one, you can give your $10,000 directly to Vanguard, the mutual fund manager, and get the shares in return. And if you have holdings at Vanguard, the way it looks on the statements is you have this big, long account number and you own shares directly with the mutual fund manager. What you can also do is open a brokerage account at Vanguard or Schwab or Fidelity or E-Trade or wherever and buy shares of the mutual fund and place them in that brokerage account along with other stuff. So you might have shares of Apple stock or bonds or cash vehicles or whatever alongside mutual funds that you buy in that account. With the mutual fund, all you own is the mutual fund. You cannot put other stuff alongside it. The statement you get from the manager is there's no mechanism to hold other stuff. It's just shares of that fund. So there are two different ways to do this. And if you're holding the Vanguard mutual fund and they're going to convert that to an ETF, well, now you've got to designate a place for the ETF to live. So you have to have a brokerage account open. I don't know exactly how mutual funds are going to handle this, but I suspect that they have, especially at a place like Vanguard that does offer brokerage accounts anyway, they probably have the ability to open an account in your name on your behalf to place the shares of the ETF after the mutual fund's been converted. So not a reason to freak out, but you will have the authority to place the shares of the ETF resulting from the conversion wherever you want. And so if you do have a brokerage account open already, it's just something to pay attention to. And I would probably want to direct them to put those shares in the account you already have open, because consolidating is always just a little bit easier. All right. So those are the main things I wanted to cover today. Is this is a growing trend. Don't be freaked out if it happens. There are dimensional funds that we've held in client accounts that have converted, and it's been a good deal for everybody where we've not intervened, and we've decided not to intervene and take action. Because the ETF structure can make a lot more sense depending on the strategy. So there are situations when you might not want to accept that change. You might want to say, you know what, an ETF is not right for me. I'm going to go ahead and sell the mutual fund before the conversion happens. And, I can think up a fact pattern and profile where that makes sense, but it really depends on your circumstances and what the strategy you're trying to pursue in your portfolio, what your accounts look like, what your assets and liabilities look like, and really what your intention is with your savings and your investments. So that's it's a growing trend. It's because ETFs are really popular these days. It's because the SEC had a favorable ruling toward actively managed ETFs here recently. And I think that pretty much does it. So that's it for this week. I thank you all for listening, and I look forward to talking to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.